Hello, Sector Watchers. Welcome to the show. This is the 70th episode of Sector Spotlight for Tuesday, the 9th of March, recording it on Monday the 8th. I would always start this introduction by telling you that you could connect with me with the handles on the screen, and obviously that is still the case. But then we would say, if you like the show, give us a thumbs up, or if you want to engage into the discussion, put your comments in the box below. However, probably a lot of you are now watching this show and the other shows of StockCharts TV on any of the on-demand options, Apple TV, Roku, I don't even know where it is. It's on all the on-demand channels. And obviously we can't do a like and we can't do put your comments in the box below. So if you're on YouTube, thumbs up, give us a comment in the box below. If you're on any of the on-demand channels, please use any of the handles on the screen. For today, we're going to look at obviously what happened last week in sectors and asset classes. Then I want to put things into perspective, grabbing back to one of the metrics that we used a while ago, which is beta. I've updated my spreadsheet that holds the rolling betas for sectors. I'm going to overlay those on what we currently see and see if that gives us any meaningful results. I want to also go into international stock markets and connect that to the rotation that I see in currencies, because I think there's an interesting rotation going on in the currency markets. If we have any time left, we'll see if we can find any nice RRGs to share with you. For now, let's start with the overview of what happened last week. On the left-hand side, we have the RRG showing 5 days of rotation in asset classes. And on the right-hand side, we have 5 days of rotations in US sectors. If we start at the left, then we see that our benchmark, the VBINX, lost 10 basis points, 0.1% last week. And stocks outperformed. Gained 0.3%, and almost by default that means that government bonds have underperformed. They lost 0.8%. The winners, again, the commodity ETFs, 3.8 for GSG and 1.0 for DJP, and also remarkably strong the US dollar, and we're going to get back to that later in the show. But it's a nice move. Here on the daily, pushing into the leading quadrant. At the bottom we have corporate bonds and real estate losing 1.1 and 1.7%. We quickly move over to the right hand side where we have our sector universe, then we can see quite a big difference actually. S&P gained 0.9% for the week, and you see that the big gainers were energy, with 10%, and then followed by financials, 4.3, industrials, 3.1, communication services, 2.5, materials, 2.4, utilities, 2.3, and staples, 2.2% higher. These are all higher, which is quite a lot. They're all outperforming the S&P for the week. And then at the bottom, below the S&P, so underperforming the S&P, are healthcare, tech, real estate, and discretionary. And what you can see here is that because in the end this is a closed universe, all these sectors make up the S&P. And for the S&P to gain 90 basis points, we do need a lot of sectors outperforming by quite a bit to offset the losses in big sectors like discretionary and technology. So that's the reason, that's the logic why you got a lot of sectors that are outperforming, and you do need to outperform quite a lot to offset those heavy losses inside discretionary and technology. So for the week, continuing to see strong rotations for energy, financials, industrials, materials, they started to roll over a little bit, and so did financials. And where you really don't want to be is technology, discretionary. Utilities is picking up, but it's really at the low side on this daily RRG. So we're going to look at the longer term images, starting with the asset classes, and then picking up the image for weekly rotations on US sectors. How do these short-term rotations fit in with the longer-term picture? On the left-hand side, the RRG is now a weekly RRG for asset classes. And what we see here is the strength for commodities with GSG and DJP strongly moving into the leading quadrant and moving further into it. They're now joined by V&Q. 2 weeks ago when we talked about seasonality, we spoke about the possible surprise, seasonal surprise for V&Q. That seems to be working out, at least in terms of relative strength. We still have stocks with ITOT on the right-hand side, quite far to the right-hand side, so that's a positive thing. And with a relatively short tail, that means that the uptrend, the relative uptrend, is up and stable. So there's not a lot of power, not a lot of momentum behind it, but there's also no negative momentum on this rollover for the time being. We go to the left-hand side. We see government bonds moving higher opposite of stocks. It's primarily a momentum-based move, relative momentum-based move, because it's only going up vertically and it's not much moving to the right. And the same goes for stocks that are going down. So these vertical moves are momentum-based moves, and stocks are not really losing relative strength versus the benchmark, and government bonds are not really gaining relative strength versus the benchmark. At least that's the situation for now, and that's what you really want to monitor when you look at these RRGs. As soon as these tails start to move, so if stocks start to move lower on the RS ratio scale and they pick up momentum, that's a time to start worrying. And well, obviously when that happens, you will see government bonds making that same move on the opposite side. So they will start moving higher on the RS ratio scale and picking up momentum. For the time being, that is not the case yet. We see high yield picking up a little bit, and we see the strength of the US dollar that we also saw on the daily RRG picking up here. In terms of asset classes, it's still weak, but it's got a nice push, a nice momentum value behind it. Now, if we put that on regular charts, then I've already loaded up ITOT for stocks, and you can see that relative trend is still working its way higher. It's losing a little bit of relative strength, relative momentum, and that's causing that red line to roll over, and that's what you see here. And the reason why that tail is so short is because these lines are not exactly moving parallel, but they're not making big swings on the scales, so that's causing that tail to shorten. Trend intact in price terms. This long-term trend is still in play. We're going to have a look at the shorter-term SPY when we talk about sectors. It's a little bit different there. I'm not really sure, but the long-term picture, just look at it from a pure trend perspective. This is still good for now. Let's quickly move to those commodity charts, because they look very interesting. So we've got DJP pushing higher. We're running into that resistance area near 25.5. In terms of relative strength, there is no weakness visible. As a matter of fact, DJP just picked up strength again and started to move higher. And somewhat similar is visible for GSG, where I find it difficult to draw a trend line here because it would only touch 2 points, and that's not very meaningful. What I do like is the taking out of that horizontal barrier here in relative strength, and there's plenty of upside against VBINX for this commodity. So commodities, I think, definitely deserve a position in a portfolio, maybe even if it's small, but there's a very good relative trend ongoing. If we have a look at high yield, then we see that is rolling over, and that relative strength is, I adjusted that trend line that was running right here, and it started to be somewhere up in the clouds. So I adjusted it over the most recent highs, best as I could. Still below that, still lower highs and lower lows, which makes it a clear downtrend. And the fact that it's picking up a little bit on the momentum scale, in terms of RS ratio, it's still very low. So I'd be very, very careful with that. And somewhat similar image you will see for corporate bonds, which is obviously still a very weak price chart, completed that double top and is now underway. I think the first real support level is somewhere in the 123, 124 US dollars. And look at this relative trend. That is definitely going down, and that's what's picked up by those RRG lines that are slowly, gradually moving lower and almost stable. And that's causing that very short tail here for LQD inside the lagging quadrant. So for the time being, long-term picture, still positive for stocks, potential surprise for real estate, strong rotation for US dollars, and definitely an interesting rotation for commodities at the moment. Before we start looking into the sectors and the sector rotation on the weekly RRG, I want to go back to the daily chart for SPY. I introduced looking at this chart a couple of weeks ago, just to give a little bit more short-term flavor to what I think is going on in the stock market. And last week we discussed the fact that this bar here broke below its previous low and how it started to go back up. There was this one here. And you see that we did not make it back above that 392. Actually, we put in another lower high, because this is today, the market is closed now. So this is Friday, Thursday, Wednesday, Tuesday, Monday. This is when we recorded it and when we last spoke. And I said if we get in a lower high and we take out this low here, then we're in a short-term downtrend, or it's confirmed. And that's exactly what happened. So we did not get above that 392 high. We took out that 382 low, albeit marginally, and we're doing that again. So on this daily chart, we are now clearly seeing a structure of lower highs and lower lows, and that's the definition of a downtrend. And we're struggling, we're breaking these rising support lines. All in all, that's not very good for the short-term outlook for the stock market. So I'm pretty cautious for the near term. We talked about the longer term when we spoke about asset classes. You saw stocks still on the right-hand side and government bonds on the left-hand side. That ratio, that relationship is still in favor of stocks long term. I think if we zoom in to a shorter term picture, we gotta probably take into account that we will see a little bit more weakness ahead. And especially, today, this is today, we started higher. We made a nice high compared to Friday, but we couldn't maintain it. And we closed below Friday's close. So this is essentially a weak bar today. And well, we can't say that this is a high yet, but if we get another bar today that doesn't take out this high, then we have another lower high, and that becomes quite short-term negative. I'm looking at 370, this level here, 371.8, 372. Let's round it off at an area around 370. If that gives way, we're probably in for a little bit more weakness to the downside in general market terms. We're quickly going for a break right now, and after that, we're going to take a look at individual sectors and combine that with the 12-month rolling beta for those sectors. And welcome back. If you've been watching Sector Spotlight for a while and reading the RRG blog, you may remember that I started playing around with beta as a metric for gauging offensive and defensive sectors a while ago. And I've loaded up a ChartWatchers article actually of May that I wrote about the subject. And the reason that I'm putting in this article is because I had calculated a number of beta values at the time. So remember, here on the left-hand side is an article that was written in May of 2020. And here we have the spreadsheet that allows me to calculate those same betas, but with updated data. So if we go to do 60 months on this one and we rank it, we can actually see the differences between those values. And you can see that energy and financials are still coming out on top. Industrials, you see that materials has dropped. It was 115, it's now 106. Discretionary is still there. Technology, almost the same, 103, 106. And then we have communication services, which is sort of the market, still over a 5-year period. This is a long period. And you see classical defensive sectors, healthcare, real estate, staples, and utilities. They're all at the lower end. So this is sort of this confirms the traditional classification of sectors, with the high beta being sort of the offensive sectors, growth sectors, and the low beta sectors, the defensive or value sectors. Probably, yeah, a lot of value stocks in there. If we move to a shorter period and we do the same over 36 months and we rank it, then you'll see that there are a bit more differences coming to life. And you see that tech here, it creeped up a little bit. It's 107, 1.07, 101. We have energy still leading the pack. Financials second, industrials here just above it. They sort of swapped. Discretionary, tech and materials, and the lower end is still the same. If we then move to the 12-month period, and we see a little bit more differences. We see that energy is still on top. We see now that technology is actually the second sector. So here it was below. So the last time that we used this, technology was at a beta of 0.93, and it's now 1.22. That's 0.5 higher. That's in this metric, it's quite high. And you can see that technology is now the second sector in terms of beta. And that's quite interesting because when I wrote that article, we talked about technology being the new defensive sector. That has now shifted. Technology is now the second highest sector, the second highest beta, and it's back where it belongs, I guess, which is a growth sector with a high beta. So probably this was the exception to the rule, and we're now back to where technology belongs, together with discretionary, that was there all along. And we have communication services creeping up a little bit. And now you see that there is also now a majority of sectors with betas below 1, where utilities is sort of completely off the charts, like zero correlation, zero sensitivity to the market as a whole over this 12-month period, making it a very defensive sector together with utilities, and then to a lesser extent healthcare and real estate. We can obviously do it for a 3-month period, then it becomes quite crazy, to be honest, and you can actually see some negatives here and a super high sensitivity. Basically, this means is invertedly. So when the market rises, these drop, and when the market drops, these rise. So that's, well, pretty much unclear, I would say. maybe we should not use that at all. What I want to focus on is the 12-month beta. The next comparison I would like to show you is overlaying those beta values on the RRG. And on the left-hand side, you see the RRG of May, and there was a clear concentration of red, so lower betas on the right-hand side, and the higher betas on the left-hand side. And the higher betas were, at that time, curling back up and picking up momentum and starting to move higher, while the red ones, so the lower ones, were rotating out of favor. So that was the time where high beta got back into favor and making its run up as we've seen it. Now, if we look at the situation right now, then it's a lot less clear, a lot less, there's no nice clear split between those groups. What we see here, the one I zoomed out or zoomed in, so this one dropped off, that's energy, 1.96, way up inside the leading quadrant. Obviously we have financials, so these two are now leading sectors, energy and financials, although their beta is completely different over the last 12 months. Communication services is the only one of the three that we discussed. Tech, communication services, discretionary. Communication services is the only one that's actually living up to the expectations and powering into the leading quadrant. And the two heavyweights, technology and discretionary, at 1.2, roughly 1.2 each, are now moving into the lagging quadrant and showing pretty nasty charts on their price and sector charts. So my take from this image with the beta overlay is that the highest betas, or two of the highest betas, are also the heaviest weight sectors are pushing into the lagging quadrant. And combine that with the sort of short-term weakness that we saw in SPY, gives me all the reasons to check what's going on inside the charts, or on the charts, on the price charts for tech and discretionary. I have isolated the tails for technology and discretionary and the RRG on the left, and on the right hand side we have the chart for technology. If we scroll back a few weeks on the RRG, then we can see that until here, this is start of February, and even first 2 weeks of February, things were looking pretty good. Technology and discretionary were both rotating back into the leading quadrant after a stint through weakening. Usually that's a strong sign. What happened then is a very rapid, so here in the week of the 22nd, the tails hooked back, and we are now shooting into the lagging quadrant with increasing speed, with increasing momentum. If you would look at that on the daily RRG, you would see that they actually are going through a clockwise rotation. So that's what the very sharp hook on that weekly is, actually a nice rotation on the daily, on the shorter term time frame. Now, how does that look on the price chart? If we go to technology, we've been discussing this sideways move here in relative strength for a while already, and we gave it the benefit of the doubt for a little while when it started to bottom out here and potentially move higher when it moved to new highs. That is now off the charts, or out of the cards. It's off. I mean, that bet is off. We're now going out of that range, but not on the upside, but on the downside. And we're rolling over. Both RRG lines are now nosediving below 100. And we are now in for a period of relative underperformance for technology. And remember, guys and girls, this is one of the bigger sectors in the market. So the S&P, the general market, will have a very hard time keeping up while technology goes through a correction. And if we add the chart of discretionary to that, which is another very big sector inside the S&P, you'll see an even more pronounced turnaround in relative strength. This is a very nice, very clearly well-defined double top that's completed. And you see that the RRG lines, they tried, but it didn't work. And that's the hook that you see on the RRG. And discretionary is also now nosediving in terms of relative strength. So we got discretionary and technology showing weak price charts, because we're completing a nice top formation here as well, and very weak relative charts. That's not a lot of good news for the market as a whole. Long term, as I said before the break, preference still for stocks, but you probably should not be buying stocks right now, because I do think that we will see better opportunities in the weeks ahead, especially if these two big sectors, tech and discretionary, continue to go down and underperform the benchmark, or basically drag the benchmark down. An important move, or a remarkable move, is underway in currencies. On the left-hand side, we have the RRG showing the rotation for currencies versus the US dollar. And what you can see is that pretty much all of these tails are pointing in a northwestern lower left-hand corner direction. And that means that they are all weakening versus the US dollar, which is the center of the chart. And we can even do this on a daily scale. And you can see that a similar picture is going on there. Everything is weakening against the US dollar. That means dollar strength, which is what we saw on the asset class RRG at the start of the show. Now, I'm gonna refresh your memory by bringing up this monthly chart of the US dollar index and the US dollar, euro dollar relationship. And there you see that the dollar index is moving down, is in a long-term down move, and euro dollar is basically in a long-term up move. We took out this falling resistance line somewhere in 2020, in the middle of 2020, and have been working our way higher. What we are now seeing is the shorter term picture, and this here is the daily chart of euro dollar. And you can see that it has just completed a topish formation, started a new downtrend. So there's definitely weakness ahead for euro dollar. And I could see it go to 116, maybe even 114, which is quite a significant move, but it's still within the longer term picture so the dollar strength is within the longer term picture of dollar weakness and euro strength. So having said that, but how can we tie that to potential stock investments? Sometimes we talk about international markets, and what you can see here is the RRG for international stock indexes. And you can see that the S&P has started to rotate higher, and a lot of these other tails are moving counter the S&P, especially, for example, you see here Europe. That means in an international perspective, despite the short-term weakness that we see, the US market is probably the best inside that international space, because as a US investor right now, when you buy foreign markets, you're basically shorting US dollars, which is not going to help your foreign investments. So for the time being, despite the weakness in international space, I'd like to stick with US markets. Be careful with foreign investments, especially, big Euro US block. That's definitely in favor of the US at the moment. We're going to wrap it up. Ladies and gentlemen, this was Sector Spotlight for today. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. You can see us on all the on-demand channels and on YouTube. If you watch it on YouTube, give us a thumbs up and leave us a comment in the box below. Otherwise, use the email. Thank you very much, and I hope to see you again next week.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.